So, hello everyone. I'll try to take a look at my. If I'm starting, yeah, so I'm starting. So, again, um, I will be talking about employee benefits, the second part. My name is Hannah May Gargantiel, and a student of marketing management, and I'm in my second year. So, let's start with my topic. So, these are our learning competencies in this chapter. We should be able to state the accounting procedures for defined benefit plans, state the components of defined benefit cost, and describe the accounting for other long-term employee benefits and termination benefits. So what is accounting for defined benefit plan? The employer has an obligation towards his employees, which is to provide the agreed benefits. This is risky for the employers since these promised benefits will cost more than expected if actuarial or investment experience is worse than expected. So we all know that um, when we go to work, once we graduate from college, it is already expected that we can we can get benefits when we become employed, and that is the responsibility of the employer, of our employer. Though this plan, these benefits, I mean, can actually is actually risky for the employer because again it might cost them than what is expected. So actuarial assumptions, which is mentioned above are necessary to measure the obligation on a discounted basis resulting to actuarial gains or losses. And retire benefit cost is not necessarily equal to contribution due for the period. Accounting for defined benefit plan involves the following steps. So these are the steps for the accounting for defined benefit plan. So first step, determine the deficit or surplus. The deficit or surplus is the difference between the following. So again, we have to determine, we are all familiar of what is deficit and surplus, right? So when you say deficit, that means it is lacking or you may be at loss. While surplus means you have something extra. You have something that is more than what you are expecting. So the deficit or surplus is the difference between the following: present value of the defined benefit obligation, the present value or PV of DBO, or I'm going to explain DBO later, and fair value of plan assets, or FVPA. I just remembered. DBO is actually defined benefit obligation. Present value of DBO represents the entity's obligation for the accumulated retirement benefits by employees to date, determined using an actuarial valuation called the projected unit credit method. FVPA represents the balance of any fund set aside for payment of the retirement benefits. If FVPA is less than present value of DBO, the difference is a deficit. And if FVPA is more than PV, or present value of defined benefit obligation, the difference is a surplus. For the second step, determine the net defined benefit liability or asset. The net benefit defined benefit liability or asset is the amount that is presented in the statement of financial position. So when we go to the two parts of accounting, we can see that there is the income statement and the balance sheet. So when you say, another term for income statement is the statement of comprehensive income, while the balance sheet in other terms is financial position, statement of financial position. So the net defined benefit liability or asset should be presented in the balance sheet. If there is a deficit, the deficit is a net defined benefit liability. If there is surplus, the net defined benefit asset is the lower of the surplus and asset ceiling. So, asset ceiling is the present value of any economic benefits available in the form of refunds from the plan or reductions in future contributions to the plan. In step 3, determine the defined benefit cost. And in order to determine the defined benefit cost, we need to use a formula. And it is presented below. It's illustrated. So in here, we have the service cost. And this is recognized in PL, or the profit or loss. So we have the A, current service cost, the past service cost, and any gain or loss in settlement. And the second part is the net interest and the net defined benefit liability or asset, and still recognized in PL. And the measurement of the net defined benefit liability, still asset, which is recognized in OCI. And so when we add everything and maybe subtract what's in the credit side to the debit side, then we get the total defined benefit cost. Now we are going to talk about service cost. Current service cost is the increase in the present value of defined benefit obligation resulting from employee service in the current period. An employee's retirement benefit increases as he or she renders service. For example, an employee who has rendered 20 years of service would have higher retirement benefits than an employee who has rendered only 10 years of service. Of course, that's very understandable, and that is very relatable for anyone who has been working in a company for such a long time, assuming they have similar position and salary levels. Current service cost represents the increase in the employee's retirement benefit because of the services he or she has rendered during the current year. Well, the past service cost is the change of present value of DBO for employee service in prior periods resulting from a plan amendment or curtailment. Past service cost, whether vested or unvested, is recognized immediately as expense, A, when the plan amendment or curtailment occurs, or B, when the entity recognizes related restructuring costs or termination benefits, whichever comes earlier. Unvested past service costs are not deferred or amortized. A plan amendment occurs when an entity introduces or withdraws a defined benefit plan or changes the benefit payable under an existing defined benefit plan. A curtailment occurs when an entity significantly reduces the number of employees covered by a plan. It may arise from an isolated event, such as the closing of a plant, discontinuance of an operation, or termination or suspension of a plan. Now, past service costs can be positive when present value of DBO increases or negative when PV of DBO decreases. Gain or loss on settlement arises when the employer's obligation to provide benefits is eliminated other than from payment of benefits according to the terms of plan. The gain or loss on a settlement is the difference between A, the present value of the defined benefit obligation being settled as determined on the date of settlement, and B, the settlement price including any plan assets transferred and any payments made directly by the entity in connection with the settlement. Net interest on the net defined benefit liability asset. Net interest on the net defined benefit liability asset is a change in the net defined benefit liability asset during the period that arises from the passage of time. It comprises the three items listed in the formula above. The same discount rate is used for the three items. This discount rate is based on high-quality corporate bonds, or in the absence thereof, on government bonds determined at the start of the annual reporting period. Remeasurements of the net defined benefit liability asset. We have the actuarial gains and losses. Are changes in the present value of defined benefit obligation resulting from changes in actuarial assumptions. Actuarial assumptions are estimates of variables used in determining the ultimate cost of providing post-employment benefits. These include the demographic assumptions, for example, employee turnover rate, mortality, or lifespan and health condition, and financial assumptions, for example, discount rate, future salary levels, and future medical costs. So when you say demographic assumptions, this pertains to the employee, while financial assumptions pertain to money matters, such as costs and market rates. The discount rate used in measuring defined benefit obligations and costs is based on high-quality corporate bonds. Return on plan assets represents the investment income earned by the plan assets during the year after deducting the costs of managing the fund and taxes. And so we have an illustration here. Information on entity A's defined benefit plan is as follows. PV of DBO on January 1, 20X1 is 1,500,000. FVPA on January 1, 20X1 is 1,200,000 pesos. PV of DBO on December 31, 20X1 is 1,800,000 pesos, and FVPA December 31, 20X1 is 1,310,000 pesos. We have the current service cost here, which is 325,000. Actuarial gain 100,000, return on plan assets 110,000, and the discount rate being 5%. The requirement here is compute for the amounts that will be presented in entity A's December 31, 20X1 statement of financial position and statement of comprehensive income. So here is the solution. Step 1, determine the deficit or surplus. FVPA on December 31, 20X1, which is 1,310,000 pesos, and the PV of DBO December 31, 20X1, which is 1,800,000 pesos. It's a deficit since this is FVPA is much smaller than the PV of DBO, both on December 31, 20X1, and it is equals to 490,000, and that is a negative, and that's why it's a deficit. Step number 2, determine the net defined benefit liability asset. The net defined benefit is 490,000. The deficit determined in its step number 1. This is presented in the concurrent liability section of Entity A's December 31, 20X1 Statement of Financial Position. The net defined benefit liability in the preceding year is 300,000 pesos, 1.2 million FVPA as the beginning, and the minus 1.5 million PV of DBO beginning. While step 3, we have to determine the defined benefit cost. So in here, we have the service cost, the current service cost being 325,000, the past service cost and any gain or loss on settlement being blank is equals to only 325,000. Net interest on the net defined benefit liability asset, interest cost on the DBO 75,000, interest income on planned assets 60,000, and the two are subtracted from each other. And we have the interest and the effect of the asset ceiling, which is blank. So our net interest on the net defined benefit liability is 15,000. Remeasurements of the net defined benefit liability asset: A. Actuarial gains and losses, which is a negative 100,000. And the difference between interest and income on planned assets and return on planned assets is negative 50,000. While the difference between the interest and the effect of the asset ceiling and change in the effect of the asset ceiling is blank. So that equals to 150,000, still negative. And we now have the total defined benefit cost, which is 190,000 pesos. So we just add the service cost, the net interest on the net defined benefit liability asset, and the remeasurement of the net defined benefit liability or asset. Or more like we add the two service costs and net interest on the net defined benefit liability asset, and then subtract 150,000 as the measurements of the net defined benefit liability asset, and equals to the total defined benefit cost. And now we have the present value of the defined benefit obligation, the T account. Present value of, okay. So on the debit side, we have the benefits paid, the actuarial gain due to decrease in PV of DBO, and you also have on the credit side the beginning, the current and past service cost, the interest cost, and actuarial loss due to increase in PV of DBO. And we have the end. Okay. So again, we have an illustration because of what we talked about earlier. Is an example. The present value of defined benefit obligation. Information on ABC Company's defined benefit plan is shown below. Present value of defined benefit obligation January 1 is 120,000 pesos. The current service cost, which is 30,000 pesos. Discount rate 10%. And benefits paid to retirees 50,000. And the decrease in present value of defined benefit obligation during the year due to changes in actuarial assumptions is 10,000. So requirement here is to compute for the ending balance of the PV of DBO. And we have the solution. Benefits paid is 50,000. Actuarial gain decrease in PV of DBO 10,000. 100 on the credit side, we have the 120,000 on January 1 and 30,000 for current service cost. And we also have the interest cost, which is 12,000. So on December 31, everything is totaled to 102,000. And we also have the illustration 2 for current service cost. The information on ABC Company's defined benefit plan is shown below. So it's the same. And we have the requirement. Compute for the current service cost. And this is the solution. Benefits paid on the debit side. 120,000 January 1 on the credit side, as long as 30,000 current service cost and 12,000 pesos interest cost and 10,000 as actuarial loss increase in PV of DBO. And on December 31 we got 122,000. Current service cost is simply squeezed after placing relevant information on the T account. Okay, let's go to the fair value of plan assets T account. Fair value is the price that would be received to sell an asset, or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So plan assets comprise of A. Assets held by a long-term employee benefit fund, and B. Qualifying insurance policies. Assets held by a long-term employee benefit fund or assets held by an entity, a fund, that is legally separate from the employer. A qualifying insurance policy is an insurance policy issued by an inquirer that is not related to the employer. Plan assets are reduced by any liabilities of the fund that do not relate to employee benefits. So in here, we can see an illustration. On the beginning, on the debit side, we have the beginning, the return on plan assets, and the contributions to the fund. And on the credit side, we have the benefits paid, and also on the credit side, disclosed with the end. Determining the ultimate cost of a defined benefit. The ultimate cost of a defined benefit plan may be influenced by many variables such as final salaries, employee contributions, and medical cost trends. The ultimate cost of the plan is uncertain, and this uncertainty is likely to persist over a long period of time. In order to measure the present value of the post-employment benefit obligations and the related current service costs, it is necessary A. to apply an actuarial valuation method, B. to attribute benefit to periods of service, and C. to make actuarial assumptions. For the actuarial valuation method, or the projected unit credit method, sees each period of service as giving rise to an additional unit of benefit entitlement and measures each unit separately to build up the final obligation. So we have an illustration here. ABC Company agrees to provide a lump sum retirement benefit to employees equal to 6% of final salary for each year of service. And we have the information on employees shown below. The annual salary level on January 1, 20X1 is 3 million pesos. And the annual salary increase starting in 20X2 is by 3%. Service years before retirement is 5 years. And the discount rate per year is 10%. So what are the requirements? How much is how much is the ultimate cost of the defined benefit plan or the lump sum payment to be received by the employee? How much are the current service costs in 20x1, 20x2, 20x3, 20x4, and 20x5 respectively? And C, how much is the balance of the PV of DBO at each year end in 20x1, 20x2, 20x3, 20x4, and 20x5 respectively? And we have the solution. Requirement A, ultimate cost of the defined benefit plan. The plan formula is lump sum payment equal to 6% of final salary multiplied by the number of years of service. So we have the final salary level, which is 3,376,526. That's really big. And we multiply it by 6%. And we can see the retirement benefit entitlement per year of service, which is 202,592. Multiplied by years of service is 5 before the retirement. And the lump sum retirement benefit, which is 1,012,960. And the second requirement, current service cost. Current service cost is simply the present value of the retirement benefit entitlement per year of service. So we have the date here. The retirement benefit entitlement per year of service, the present value of 1, the current service cost. And maybe this is the last requirement. The present value of DBO. Present value of defined benefit obligation is simply the present value of the accumulated retirement benefit entitlement to date. So we have the date here, the accumulated retirement benefits to date, and the PV of 1 at 10%, and the PV of DBO. And you have to remember the following. Current service cost is the benefit entitlement per year times PV factor, and the PV of DBO accumulated is equals to accumulated benefits times PV factor. Attributing benefit to periods of service using the plan formula. However, if benefits are materially higher for services rendered in later years than in earlier years, the benefits are attributed on a straight line basis from the date of the employee's entitlement to benefits starts to accrue until the date where future services will no longer lead to material amount of benefits. We have the illustration 1 here. Fact pattern. ABC Company's defined benefit plan provides a lump sum benefit of 10,000 pesos for each year of service payable on retirement. So the case 1, benefit attributed to each period of service. Mr. Juan is an employee of ABC Company. How much benefit is attributed to each year of service rendered by Mr. Juan? And the answer is 10,000 pesos. And this amount is determined using the plan formula. The second case is for current service cost. Mr. Juan has rendered service in year 1. How much is the current service cost in year 1? So we have to know that the appropriate present value factor is 0.683013 period. Solution: current service cost 10,000 pesos times 0.683013 is equals to 6,830.13. In the third case, present value of defined benefit obligation. Mr. Juan has rendered services in years 1 to 3. How much is the balance of the PV or DBO at the end of the year 3? The appropriate PV factor is 0.826446. And the solution is PV or DBO is equal to accumulated benefits times PV factor, 10,000 times 3 years, and then times 0.826446 is equals to 24,793.38 pesos. And let's go to reimbursements. When it is virtually certain that another party will reimburse some or all of the expenditure required to settle a defined benefit obligation, an entity recognizes its right to reimbursement as a separate asset measured at fair value. So when you say reimbursement, this can be adding another money put it simply, or mm, to I don't know, it's to refill one's shop, or one's business when it runs out of cash. Okay? Maybe because of debts and stuff like that. Overfunding or underfunding. Retirement plan is said to be overfunded if there is net defined benefit asset, and underfunded if there is net defined benefit liability. If the fair value of the plan assets is equal to or greater than the present value of the defined benefit obligation, the retirement plan is said to be fully funded. So we have an illustration here. ABC Co. has a defined benefit retirement plan. ABC's contributions in 20X1 and 20X2 fully funded the plan. Information on December 31, 20X3 is as follows. So let's take a look at the table. And our requirement is how much should ABC contribute. In 20X4, in order to report a net defined benefit liability of 5,000 pesos on December 31, 20X4, and we have a solution here. On the debit side, we have the contribution for 20X3, 10,000 pesos. Contribution 20X4, which is squeezed, 50,000. And on the credit side, we have a blank beginning for January 1, 20X3. But we have a 25,000 defined benefit cost 20X3 for 20X3, and 40,000 pesos defined benefit cost for 20X4. So it is now enclosed or closed on the debit side, which is December 31, 20X4, or the desired balance, which is 5,000. Offsetting. An asset relating to one plan is offset against a liability relating to another plan only when the entity has both A legally enforceable right to use a surplus in one plan to settle obligation under the other plan, and B, an intention to either settle the obligations on a net basis or to realize the surplus in one plan and settle its obligation under the other plan simultaneously. Other long-term employee benefits. Other long-term benefits are employee benefits other than post-employment benefits and termination benefits that are due to be settled beyond 12 months after the end of the period in which the employees have rendered the related service. We have the examples. A. Long-term compensated absences, for example, sabbatical leave. B. Jubilee or other long service benefits. Or C. Long-term disability benefits. D. Profit sharing, bonuses, and deferred compensation payable with beyond 12 months after the end of the period in which the benefits were earned. What are termination benefits? Are those provided as a result of either A. the entity's decision to terminate the employee before normal retirement date, or B. the employee's decision to accept the employer's offer of benefits in exchange for termination. Unlike the other types of employee benefits, the obligation to pay termination benefits arises from the employer's act of terminating an employee rather than from employee service. Recognition. Termination benefits are recognized as a liability and expense at the following dates. A. When the entity can no longer withdraw the offer of those benefits, and B. And when the entity recognizes restructuring costs under PAS 37 that involve payment of termination benefits. Measurement. Termination benefits are accounted for according to their nature. Termination benefits that are A. payable within 12 months are accounted as short-term benefits. B. Payable within 12 months are accounted for as other long-term benefits, and C. Enhancement to post-employment benefits are accounted for as post-employment benefits. And we have an illustration here. ABC company plans to close a branch with 20 employees in 3 months' time. To fill in some pending customer orders, ABC company offers its employees the following: A. Each employee who stays and renders service until the closure of the branch will receive 100,000 pesos on the termination date. And B. Employees who leave before the closure will receive 40,000. Half of the employees are expected to leave before closure. Requirement: how much is the liability for termination of benefits? So you have a solution here. The termination benefit is 40,000 pesos per employee. This is the amount that ABC company has to pay for terminating the employee regardless of whether he or she stays and renders service until closure or leaves before closure. The 90,000 pesos excess is short-term benefit because this is paid in exchange for service rather than termination. The total termination benefits are computed as follows. Number of employees in the branch, 20. Termination benefit per employee, 40,000. Liability for termination benefits is 800,000 pesos. The expected number of employees staying or leaving does not affect the computation because all of them will be terminated upon closure of the branch, regardless of whether they stay and render service until the closure or leave before the closure. The short-term benefits of 90,000 pesos are recognized over the 3-month period as the employees render service. And that's all. Thank you so much for listening to my topic, and I hope you learned something from it. Thank you and goodbye.